What I'll do today is have uh, with this lectures, I'll leave a little bit more time at the end for questions, and also because um, it is uh, it is late for those of you who are in the Moscow time zone, and you know, I don't want to keep you up, or with bad dreams all night, with bad dreams of monetary theory. Okay, let me say now something about this present lecture 2, which is on the rate of interest and the business cycle. Now, when I offered these lectures to Professor Melnick, I said that these were I gave him the title. He chose this lecture, or I chose this lecture, and it's only subsequently that I realized that it's mostly about Kalecki, but then Kalecki's monetary theory is not at all well known, and maybe it should be, and it would be of interest to have to discuss in these lectures, in part because it has its original and idiosyncratic features. And this, like some of my, like some of the remaining lectures, is draws on my book on Kalecki's monetary theory, which will be coming out next year with from Oxford University Press. So I will be giving you a preview of this here. As always, I will give a short summary of what I will the main topics that I will cover. I'll give an introduction. I'll say something about the short-term rate of interest, and then the long-term rate of interest. These being the two key variables that link up monetary policy, monetary theory, and to what's happening in the real economy. And then I'll say something about debt management and the yield curve. This may appear as a new topic, but in fact it's a way of linking up both the short-term and the long-term rate of interest, and this whole idea that the function of interest rates is important for the financial system, but not much outside the financial system. And similarly, that that monetary policy is important for the financial system, but not so much outside the financial system, or not so much for the non-financial economy. Let me say a few remarks about the by way of introduction. First of all, I'm not going to put forward any models. I'm really concerned with institutions. Institutions come first. They always come first. We have to have the idea of a central bank before we can do a model of central bank operations, or before we can do a model of a central bank reaction function. So it's the institutions that come first, and also because what we're concerned with here is the circulation of money between institutions. And this is a process. It's a process that takes place between institutions. It's not something that can be readily reduced down to a set of equations, giving a relationship between between particular variables, as if and then presenting this as presenting this abstracted relationship between abstracted sets of variables as something that is real and something that is out there. This is not the case. What we have out there are institutions. There is, and you can see this in the case of the yield curve. If you go back to Irving Fisher, when he, in his earlier works, when he was presenting the arguments between the short-term borrowing and long-term borrowing, these different segments of the borrowing market, Fisher argued that there is an asymmetry between the preference of borrowers who will always want to borrow long-term, and lenders who would always like to see their money coming back to them with a fairly high frequency, so that they can check that it is actually coming back to them. It makes the lenders more secure. Now, for Fisher, he argued that this distinction between the long-term preference of the borrower and what he called the myopia of the lender is resolved by the rate of interest. It's the rate of interest that brings these two sets of different desires into equilibrium. I want to argue that actually this is resolved not by the rate of interest, but by a situation of, but by a financial innovation. And what is the financial innovation? The financial innovation is the development of the long-term bond market, in which allows firms to borrow long-term in that market, but also allows the lenders to make their commitment short-term, because there is a secondary market that allows them to recover their money at any moment. Okay, they may not, it's possible that they may not be able to determine the price at which they sell their bonds in the secondary market, but it's a way in which these asymmetric preferences are resolved, or the distinction, the differences in those asymmetric preferences is resolved, are resolved not by a price in the standard neoclassical way, that the price equilibrates supply and demand, but by an institutional innovation. The short-term rate of interest is the rate of interest on borrowed reserves at the central bank. In America, it's the US federal funds rate, or it can be the discount rate on first-class government bills. This was what used to be referred to as the bank rate in the UK. It's the difference between, it's a margin between the purchase price and the resale price of a financial security. In other words, the repo rate. The repo rate, which is the way in which central banks now, certainly in Europe, supply funds in a secure way to the short-term money markets. Again, Keynes's liquidity preference has this as the central bank supplying funds, and in the traditional post-Keynesian view, there is a demand for these funds represented by L, and if where the supply and demand crossover gives the short-term rate of interest. And then in post-Keynesian economics, there's a whole literature about horizontalism and verticalism. This supply function of money is vertical, as monetarists believe, and whether that destabilizes the rate of interest, and whether and this is supposed to be determined by the liquidity preference function here, which is represented by L, so that if this liquidity preference function shifts as it's held to regularly, then or irregularly, then this affects the rate of interest. I don't want to go into this argument because I'm now concerned more with Keynes's, and Keynes actually said, and then Kalecki's view of this. So in Keynes's theory, the central bank is supposed to set the money supply to fix the short-term rate of interest. Certainly after Britain had gone off the gold standard, this was what the central bank did, while the Bank of England was on the gold standard. Then the gold reserves set the money supply, and the rate of interest had to adjust. And for Keynes, the short-term rate of interest affects the long-term rate, and the long-term rate for Keynes is the one that affects investment and the real economy. And this is important because that is the key monetary transmission mechanism in Keynes. It is this is something which I notice in some of the more recent post-Keynesian literature has been forgotten, and there's a tendency to treat the short-term rate of interest as being, really the the important policy rate, and that the post-Keynesian view generally being that the short-term rate should be as low as possible. But the discussion of the long-term rate of interest has tended to fade out among post-Keynesians. Keynes also put forward this idea of a liquidity trap, this idea that at some point the liquidity preference curve, or the demand for money represented by L, becomes vertical, so it becomes horizontal, and no quantity of money or no quantity of additional reserves will push down the rate of interest in order to lower the long-term rate and stimulate investment. And this is what Keynes called the liquidity trap, and there are arguments as to how realistic possibility. He didn't think it was a very realistic one, but he nevertheless put forward as an important possibility. I think for analytical purposes, and to recognize the importance that liquidity actually plays in bank and firm balance sheets. Kalecki's theory of the short-term rate was rather different. Kalecki linked the short-term rate of interest with what he called the marginal convenience of holding cash. He argued that if the short-term rate is higher than this marginal convenience, then there is an inducement for lending additional cash. So surplus cash, one easily more easily lends. If the short-term rate is lower, it becomes profitable to withdraw from short-term assets and acquire cash. I mean, I don't think that this Kalecki meant profitable in the sense that you can earn an actual profit by withdrawing from short-term assets, but simply it becomes more convenient. It's profitable in terms of your convenience or to hold on to cash. So this was a kind of, this was his liquidity preference idea. And an equilibrium is reached when the short-term rate of interest is equal to the marginal convenience of holding cash. But of course, since we do not measure that we can't measure that marginal convenience. We can just take this equilibrium as being somewhere there. However, what's interesting about is that he linked it with the velocity of circulation. He argued that the higher is the short-term rate of interest, the greater is the inducement to invest money for short periods rather than to keep it as a cash reserve. Or to put it more precisely, transactions can be managed with a larger or smaller stock of money. However, a larger stock of money in relation to turnover, in other words, he meant sales or transactions, means on average a smoother and more convenient handling of transactions. In other words, you don't need to go to the bank as often if you're holding on to a larger stock of money. so that the higher the short-term rate of interest, the more expensive is this convenience as compared to the convenience of investing in short-term assets. It's something which I don't know whether probably some of the older listeners may have had the same experience that I have had since 2008. That whereas in the past, if we had a surplus in our current bank account, we would put it into a savings account or interest-bearing account in order to obtain interest. The rate of interest is now so low that people don't bother. People just simply accumulate liquidity in their in current accounts. The rate of interest doesn't make it worthwhile, shifting money between accounts. So Kalecki argued that we reached the conclusion above that the velocity of circulation v is an increasing function of the short-term rate of interest. In other words, the amount of transactions divided by the money supply influences the velocity of circulation given the short-term rate of interest. And I think the institutional foundation for this is the management of liquidity. The rate of interest, if you look at Keynes's analysis, the rate of interest essentially determines the money supply. In Kalecki's view, the rate of interest determines the money supply in the sense of the money that's sitting in households, in the public's current bank accounts, as opposed to the view that the money supply, the supply of central bank reserves, determines the rate of interest, which is which was the view of Keynes. The institutional foundation of this is the tendency of banks to hold surplus reserves. Now, this was recognized in Kaldor's monetary economics. It's an important part of his critique of monetarism. And it's the reason why households hold excess balances in bank checking accounts. In fact, it's very, very interesting to follow this in recent since the outbreak of COVID, because you find a massive upsurge in excess balances in people's bank accounts because of restrictions on spending money, and this has caused excess balances. But there is another factor unrecognized, which is the fact that the rates of interest are so low. And with firms, which is the other part of the public, households and firms, you can divide into small and medium-sized enterprises, which we leave aside for the time being. But for larger companies, there is a treasury management function. And it's this that has an important impact on firm investment, because the firms that do the private sector investment is overwhelmingly done by large firms with a treasury management function, and they're managing their liquidity more or less in accordance with Kalecki's argument of whether you hold money on current deposit available for convenient expenditure, or whether every night you take what is there and put it into the overnight loan market to earn some rate of interest. The person in modern economics more recent economics, well, I say more recent since Keynes and Kalecki, who looked at this was Baumol, put forward this transactions demand for money square root model, where he put forward the argument that the transactions demand for money, there is this thing called the transactions demand for money, of which is it's the square root of some constant fraction of transactions divided by twice the short-term rate of interest. And there have been various econometric attempts to measure this. Really back in the days, in the 1970s, the 1980s, when the demand from, there were still studies going on of the demand for money, when the money markets were supposed to be determined by the supply and demand for money. A very different view to the one that I'm trying to put forward, which is one of circulation of money. So if we compare Baumol's view, the short-term interest is supposed to affect the transactions demand for money. There's no variable velocity of circulation of money. The Kalecki view is that there are changes in the short-term rate of interest, and these affect the velocity of circulation of money and holdings of convenience money. So the situation is rather more complex, and there isn't, as the monetarists of the 1970s and 1980s believed, there isn't a constant velocity of circulation. And more specifically, Kalecki argued that the velocity of circulation of money and short-term interest rates tend to rise in the boom and fall in the recession. A phenomenon, certainly the rise in the boom and the fall in the recession, is the phenomenon which really undermines a huge amount of contemporary monetary theory. Contemporary monetary theory would suggest that if short-term interest rates are high, then there'll be a tendency for savings to rise and the economy to slip into recession. In fact, there is this what Keynes called the Gibrat paradox, but which was known really way back in the 19th century in the studies of Thomas Took, that the short-term rate of interest is a pro-cyclical variable. It's not a counter-cyclical variable. So Kalecki went on, it should be added that the movements of the short-term rate of interest in the 1930s, both in the United Kingdom and the United States, are not quite typical in pattern of velocity and interest rising in the boom and falling in the recession. Both in the United Kingdom and in the United States, there is a sharp fall in the Depression years, with a temporary reversal in 1931 in the United Kingdom. 1931 because the United Kingdom went off the gold standard, 1931. And in 1932 in the United States, reflecting the financial panic at the time. However, in the years of recovery, the short-term rate continues to fall. So this is the recovery from the low point in 1931 and 1932. Thus reflecting a basic shift in the easy money in banking policy. So when he's referring to the years of recovery, this was the Japan-style Shinzo Abe type of recovery, where there is a slow recovery, or even the one we've had in the UK and in the United States since about 2010. But it's been, it's in many respects indistinguishable from economic stagnation. You can find some evidence of recovery, but it's very slow. And what's happening there is what Kalecki called a basic shift towards easy money in banking policy. So we have shifts to easy money with the federal funds rate in the 1970s and the 1980s. Well, the shifts occurred, as you can see, in the mid-1970s in the US. And in 1980, you can see this peak, which is the Volcker shock, in effect. And subsequently, you have this downward trend, occasional increases as worries of inflation surface, but by the turn of the century, by the dot-com bubble, 1999, 2000, there's a fall in interest rates, which a gradual rise in the run-up to 2007. And in 2008, it goes down, recovers a little bit, but it's really, it went down again. And if you looked at it since COVID, of course, with COVID, it fell again. And there is now talk of increasing it. Okay, let me say now something about the long-term rate of interest. The thinking on this it has really been dominated by the view of Hicks, the pure expectations theory, chimed in much more with the earlier thinking of Irving Fisher, but also the way in which the supply and demand of money or loans is supposed to be determined by some abstracted utility function. In which firms or borrowers and lenders are supposed to be forward-looking, and the long-term rate is supposed to be an average of the expected short-term rate of interest. And I guess this would fit, albeit I think in a complex financial system. In a financial system in which there are different types of financing available. It's not just the expectations of the short-term rate of interest that count. For Kalecki said, yes, this pure expectations theory is more or less correct. He added to it, though, a risk margin. And the risk margin depends on the likelihood of a capital loss due to bond price fluctuations. Remember that the long-term rate of interest is determined in the bond market, and that's where, and in particular, the secondary bond market, so that there is a risk always that on selling a bond, that it may not realize the price that was originally paid for the bond. So there may be a loss. Okay, Kalecki's conclusion of this, and it's interesting enough, it's very similar to the view of Hawtrey, Hicks, Shackle, and others. We should remember, it's sometimes forgotten that the publication of Keynes's general theory attribute, or for that matter, his treatise on money, attaching such importance to the long-term rate of interest. Keynes's insistence that the long-term rate of interest is the key to the monetary transmission mechanism, it gave rise to a whole series of empirical studies, not only by Hicks, but also by Kaldor, Keynes's rival, Ralph Hawtrey, who advocated a more orthodox monetary and fiscal policy, George Shackle as well. But Kalecki also did his own study, and they all came to a very similar conclusion. The long-term rate does not show marked cyclical fluctuations. The short-term rate normally falls in the slump and rises in a boom because the supply of money, bank reserves, according to Kalecki, undergoes smaller fluctuations than the value of transaction. But this hasn't happened in the years of quantitative easing, but at that time it seemed, I think at the time when they were all doing these studies, this was heavily influenced by the gold standard, and it was the gold that kept these reserves anchored. Anyway, Kalecki went on that the long-term rate reflects these fluctuations only to a small extent. Indeed, the long-term rate is based on the average short-term rate expected in the next few years rather than on the current short-term rate. Well, this is the Hicks pure expectations theory. Moreover, the long-term rate changes considerably less than the expected short-term rate because the increase in it, that is the fall in the price of bonds, makes the risk of their further depreciation less likely. So there was a certain stability at that time, I think associated, in part associated with the fact that their empirical studies covered the period of the gold standard. The institutional foundations of this were in Hicks's pure expectations theory, depended on arbitrage along the yield curve. It depended on this idea that a firm seeking to borrow money had the choice between borrowing for a short period and then continuing to roll over that borrowing for successive short periods, not knowing where the rate of interest would be, but having certain expectations about that rate of interest, as opposed to borrowing for a long period of time and fixing that rate of interest. Similarly, lenders were supposed to be faced with a similar choice. There is, of course, a preferred habitat theory of the yield curve that the long-term rate is determined in the bond market, where pension funds and insurance companies operate. I mean, these are funds which, on the whole, don't depend on liquidity, don't have to maintain a liquidity because they don't have the possibility of immediate withdrawal of funds. So they don't have to keep such large liquid reserves. Whereas the short-term rate is determined in banking and money markets. And we have hedge fund. Nowadays, we have institutions like hedge funds and private equity, which arbitrage between the long and the short-term markets. However, the importance of this long-term rate, what is its importance? What is its significance? According to Kalecki, some authors have attributed to the rate of interest an important role among the forces underlying economic fluctuations. These are the Austrians, the current view, at least until 2008, inflation targeting, as it is the long-term rate that is relevant to the determination of investment and thus to the mechanism of the cyclical process. Kalecki, in this regard, believed that in the end, firms which companies which undertook investments, long-term investments, would eventually, even if they finance them by using their own reserves or borrowing money from banks, would eventually fund those investments. In other words, issue a long-term bond or equity and use the proceeds from that bond or the equity to pay off the bank debt or replenish their reserves. And in this way, what the important rate of interest was it was the long-term rate of interest. If it's the long-term, since it's the long-term rate that is relevant to determination of investment and as to the mechanism of the cyclical process, the results arrived at are of considerable significance via the fact that the long-term rate of interest does not show marked cyclical fluctuations. It can hardly be considered an important element in the mechanism of the business cycle. So Kalecki considered that the business cycle is the long-term rate is not really relevant. But what it is relevant for is it's relevant for debt management and the yield curve. So now this is the last part of my lecture. Let me now move to an important and I think neglected work by the Keynesian economist James Tobin. Of course, I will be criticized. I'm sure I will be criticized by post-Keynesians for quoting Tobin, but I think in this respect, Tobin was absolutely correct. Tobin in 1963 published an essay on debt management, and it's worth rereading. It's worth rereading today at a time when governments are massively indebted because of COVID, and central banks are trying to maintain some kind of an active monetary policy in markets that are awash with various kinds of debt. So this was Tobin's view. There is no neat way to distinguish monetary policy from debt management. That's striking because in the standard view, monetary policy doesn't have anything to do with debt management. Both the Federal Reserve and the Treasury are engaged in debt management in the broadest sense, and both have powers to influence the whole spectrum of debt. By the whole spectrum of debt, he meant the maturity spectrum. The Federal Reserve cannot make rational decisions of monetary policy without knowing what kind of debt the Treasury intends to issue. The Treasury cannot rationally determine the maturity structure of the interest-bearing debt without knowing how much debt the Federal Reserve intends to monetize. So what's striking about this contradicts, this is an early contradiction of this whole notion that central banks can independently determine monetary policy. They cannot. And in fact, this was well known in the 1940s, it was well known to Keynes, and it was well known to Kalecki through through a monetary operation that is known. The Americans call it Operation Twist, but it was known to Keynes, and Kalecki wrote about it as well. Operation Twist goes as follows. Operation Twist is a way of regulating and managing the yield curve, and shows you can actually manage the short-term rate of interest and the long-term rate of interest. And the usual way in which it's done is that you get an overissue of short-term bills, and the proceeds are used to buy long-term government bonds. Now, as it happens, long-term government bonds are principally held by long-term long-term investment institutions, and they don't sell them too readily. So if the central bank, if the Treasury is issuing these bills and using the proceeds to buy long-term government bonds, this will immediately cause bond prices to rise. And as the government bond prices rise, the government can issue new bonds at a lower rate of interest and use them to repay the bills. What does this do? It allows the government to maintain a control of short-term and long-term interest rates, or if the central bank is controlling short-term interest rates, it allows the government to control long-term interest rates, given the short-term rate of interest of the central bank. This is as opposed to quantitative easing and reserve creation to buy in bonds. This is actually the last example I've come across of Operation Twist was occurred in the United States in 2011. I think it was October 2011. Central banks have more engaged in quantitative easing and reserve creation to buy in bonds. Now, what does this mean? It usually means a pre-announced quantitative buying of bonds without creating and then creating the reserves, rather than using that money to manipulate the bond, the bill issue. What quantitative easing and reserve creation does is it increases the liquidity of portfolios, and I would argue that actually it increases the possibility of financial instability. If you have very liquid portfolios, there is a greater possibility of shifts between asset markets, which can cause financial instability. Kalecki's debt management was something different. It meant varying the financing of the budget deficit between bills and long-term bonds in order to keep the yield curve stable. In other words, to accommodate investors' liquidity preference. And Kalecki understood investors' liquidity preference as being the preference between short-term and long-term rates of interest. So he argued that if investors allocated their portfolios in a fixed proportion between long-term and short-term rates of interest, then the budget deficit should be financed between bills and long-term bonds in precisely that proportion, because when the government was spending the money either on debt management or on its current operations, in the 1940s it was on the war effort, that money was eventually ending up in investment portfolios anyway, because of the structure of exchange in the economy, of production and exchange in the economy. And Kalecki argued that the way you manage this liquidity should be through the use of wealth and profit taxes. I always say to my students that Kalecki's ideal tax was, or ideal way of financing, of debt management, of managing the debt of the government, was through a tax on holders of government debt, so that every year holders of government debt would pay the government the money that was necessary to service that debt, and every year the government would pay back to holders of government bonds the money that they had received in taxes. So you maintained a kind of fiscal circulation of money while maintaining the stability of government debt. And if you want to see the effects of government debt purchases, you can see them here. I found this very nice graph from the St. Louis Fed. There is the purple line at the top is the 10-year bond rate in Australia. The red one is the US 10-year bond rate. The Japanese one is the green one. There we are, right at the very bottom. And you can see here, this is what I meant by the Japanese central bank having gone to extreme lengths in loosening of monetary policy. The 10-year rate goes negative around 2014 and stays there flat. But overall, there's been a flattening of the yield curve. And this has certain consequences for the financial system, but we can discuss those consequences later on. I'll end my lecture here, and let's have some time for discussion.
Okay, thank you. So, are there the questions from the previous lecture? There are three.
Yeah,
please.
May I start?
Yes, please.
Okay, thank you so much, Professor, for this lecture, really enlightening. Thank you all organizers for organizing this seminar. So I wanted to ask you, because I understood that basically we are playing against the wind, and inequality within countries, inequality is on the rise because asset prices are bumped by monetary quantitative easing, monetary policy. So, like, my question is the possibility to overcome the interbanks market and directly deposit into personal account of consumers the money printed by banks will be enough to prevent this effect, or we have heavily intervene and regulate the over-the-counter derivatives market? Thanks.
Okay, thank you. This is a very, very nice question. I wonder whether you are referring to the inequality of wealth or the inequality of income, because it does have it does have an important consequence. If you certainly the taxation, I think Kalecki and my general inclination is towards taxing towards taxation of people with higher wealth, because I think it creates greater stability. It's possible then in some respects to sterilize the liquidity or any excessive liquidity in the portfolios of the wealthy. Plus, I think it's more socially just. I'm not a supporter of giving away free money. I think this is a highly controversial view. There's been certainly in America, this is one of the ways in which financial support has been given, or monetary support has been given to people who are less well off, or citizens in general. And why I'm not the reason I'm not in favor of this is that it's one of the factors which makes the portfolios of the wealthy excessively liquid. If you consider money which is given to someone who is less well off, they will not save that money. They will give that. They will spend that money on the necessities of life. That's the condition of being poor. So that money will travel through the retail system to the producers and circulate around the economy, and will end up in the portfolios of the wealthy for reasons which has to do with Kalecki's monetary and economics and his macroeconomics and his microeconomics. So this is how it ends up in the it ends up in those wealthy portfolios. If that money is given to a wealthy person, then that wealthy person will simply bank the money or go and invest it in the financial markets. Again, it creates excess liquidity, and this doesn't matter in the United States, but it does matter in all countries outside the United States, where excess liquidity gives rise to dollarization, capital flight, and so on.
Okay,
thank you so much, Professor.
And thank you. I understand Garnet has a question, right?
Yes. Thank you, Prof, for the beautiful lecture. I'm a big fan of yours from South Africa here. I wrote to you last week or so.
Yeah.
Prof, I would wonder, now during the COVID, there was a big debate here amongst economists, and all the left-leaning economists were saying the Reserve Bank must come in now and buy government debt, do some quantitative easing in other ways. The Reserve Bank was like, they ideologically rejected that, to say, no, that's a no-no. And that was against what IMF was even recommending, and even what was happening in the US and in most countries in Europe. We could see there, there was a lot of involvement and a lot of interface between fiscal and monetary policies, but whereas here in South Africa, the Reserve Bank was refusing. All they did was to lower interest rates to historically low levels. That didn't help much. In fact, fiscal consolidation, which is an approach of government to spend less, continued even during COVID, so I would wonder what would be your views about Kaleski's views with regards to developing countries like South Africa. And my observation was that most of the developing countries did not actually have active monetary policies, like even fiscal policies like countries in the developed North had. So there seemed to be some asymmetry of deployment of these monetary and fiscal policies, during this neoliberal era. For developing countries, it's like, don't do what we're doing here, continue starving your masses there. What would be your comments? And I see your lecture does not necessarily cover developing countries, but what would be your comments? Thank you.
Okay, thank you very much, Gunnar. This is a very, very good question, and it's one that my answer in the case of South Africa may not apply to all developing countries, because we're talking about a range of different countries. But in South Africa, what I would say is not to worry about what the central bank does, because actually, this is the central bank can do very little indeed. What should happen is your treasury should be more active. And how can they be more active? Your treasury can issue short-term bills. Okay. And if it issues them at a margin slightly above the central bank rate, your banks will buy those bills because they're treasury bills and they give a better return. And the government should finance it that way. It should finance itself that way. Now, what has this to do with the monetary ideas of Kaleski? Because what you would be doing in this particular case is that you would be leaving the money supply as it is. Don't worry about the money supply, but you would be making the velocity of circulation of the existing money adjust to the needs, the requirements of the government. And that's how it should be done. So you issue those short-term bills and then use the techniques of Operation Twist to ensure that the market for those bills remains stable. So issue financing along the yield curve in a more active way. While your treasury, the South African Treasury, I believe, has, I'm sure, a debt management office, which normally just sells government bonds. Mm. What they should do is turn the debt management office into the banker for the government. And that way, you can, retain the independence of the South African Reserve Bank. The South African Reserve Bank can have its right to, issue banknotes and so on. That doesn't need to bother the government.
Thank you, Prof. Your ideas make perfect sense. But here's an irony. The Treasury here is preoccupied with lowering government debt as a proportion of the GDP. So they are spending less.
Yeah.
I don't know if you say they should borrow in using short-term bills. I'm not sure if they'll accept that, because as it were, they are worried their debt is around 80% to 90, going to 90 now. I think they worry about the benchmarks that IMF has put, that debt levels should not surpass certain levels. So they're extremely hesitant to do anything that will increase the debt.
Of course, but this is, you also have to distinguish between what they say in public to keep the financial markets and the conservative financial markets and the IMF happy, and what they should be doing in practice. If you study debt management correctly, you can see that these problems can be managed. It's only those people who have an obsession with targets and impossible targets for the government who buy this story about reducing government debt. The function of the government is not to reduce government debt. The function of the government is to get people through the crisis and to do something to improve the state of South Africa. That's why your government gets elected.
Okay.
Thank you, Prof.
Robin Latimer, please.
Hello, thank you very much for your lecture. I'm trying to understand the difference between, or whether there is a difference between what you're saying and what Professor Cesarato was saying yesterday. He was saying that the central bank fixes the short-term interest rate. Do you agree?
I'm not sure. Unfortunately, what was I doing yesterday afternoon? I couldn't actually attend his lecture. Yes, the central banks in the rich countries, in the financially advanced countries, fix the short-term interest rates, but they fix them because they've taken the money market. Their target is usually the overnight interbank rate of interest. But central banks manage that overnight rate of interest because they've taken the interbank market onto their balance sheets. What I said, I think in my first lecture, that most of the most interbank transactions, that is the unsecured transactions, have as an eventual counterpart the central bank, just to make sure that their interest rate holds. But it doesn't. I mean, the effective rate is whatever one is going, whatever rate is used in the foreign exchange swaps market. So it's not, and this is what this is why the central bankers complain that their monetary transmission mechanism is broken, and that's the cause of the crisis. But this is because they don't really understand the complex banking and financial structures in which they operate. They have they know the banks that are a counterparty to them in the money markets, but they don't really see much beyond this. The complexity of what's going beyond this. If you talk about, if you look at the discussions of the monetary policy committees, they talk about the monetary effects of the rate of interest, but they don't talk about what's happening in the rest of the financial system.
Thanks, that's helpful.
Okay.
Thank you. Ilham, please.
Thank you. Regarding whether the central bank sets the interest rates, I would like to say, yes, in Turkey, as a developing country, it is also the case that Turkey central bank sets the interest rates. It is not an issue of whether it's a developed or underdeveloped countries, because money is everywhere created out of nothing. If the credit is given out of the collected deposits, as it's argued in mainstream narrative, then the interest rates will be endogenous. Okay, but in Turkey also the banks grant the credits out of nothing. If it not for so, and let's say today is the interest rate is 10%, and the central bank has reduced this to 5%. The banks reduce the credit rates also because they make money through that. If it were not so, if they had granted the credits out of the collected deposits, they would have made loss because they collected the deposit at 10% today, and they grant is tomorrow at 5%, but they make profits still because they grant the credit out of nothing.
Yeah,
that's why there is no credit supply schedule which is independent of the credit demand schedule, let's say. In that sense, I would like to ask you the long-term interest rates. I am close to this horizontalist understanding of the credit and interest rates markets, Basil Moore, Mark Lobo, and so on. And they say liquidity preferences do not determine the long-term interest rates. Rather, they determine the difference between long-term and short-term interest rates, because liquidity preference take place in a later stage of the monetary circuit, not at the beginning as assumed by Keynes.
yeah.
If so, do you agree with that? If not, why? I would ask you. If so, to what extent is the interest rate is a distributional factor? My main critique to this understanding, the horizontals, they complain about that interest rates are being exaggerated. They are right, okay.
Yeah.
But on the other hand, they suggest the central bank should also have a target for distribution, for unemployment, for growth, and so on. Then interest rates, if has a limited function, then this monetary authority has not to have so much functions or targets to conduct. That's what I would like to ask.
Yeah, I think that the real problem with this kind of a horizontalist view, the idea that there is a margin between short-term or long-term interest rates which is the one that reflects liquidity preference. Yes, this could be the case, but we're now it's not. This is. You're right that this is not Keynes's view, and I'm really, not so certain where we move. Where we go with this story. My sense is that it's you have to see, well, what does it do? What does it do for policy if the long-term rate of interest doesn't move very much at all anyway? Then whether it's caused, whether the margin between that rate and the short-term rate is caused by the business cycle or by liquidity preferences, it doesn't illuminate the argument very much. I mean, the important thing is that the long-term rate in the first place is much more difficult to manage, but can be managed if you engage in debt management. If you do if the central bank or the Treasury does these operations along the yield curve. Regarding the distributional effects on the rate of interest, I must say this is something which has come out in a lot of the critical literature, and to some degree, I think it's there is some justice in the sense that there are cases on the margins of people who are suffering, who suffer personal distress because of high interest rates, because of usury. So really, this is the kind of thing which needs to be which needs to be regulated. But I don't. I'm not sure that the rate of interest has such a substantial distributional effect. I think that I personally am very critical of the idea that the financial operations of corporations are what accounts for, and shareholder value is what account for low rates of investment. I think there's something else going on. That story is not coherent in terms of corporate financial operations. I think if there were effective yield curve management, then you could stabilize the financial markets. But the real problem is that most of the problems in the society cannot be resolved by central banks, and there is some central banker was referring to this as mission creep, the notion that central banks can resolve problems of unemployment, everything from unemployment, inflation, and climate change is I'm afraid not correct. It's not true. The sort of the mechanisms by which, and the processes by which unemployment and inflation and climate change are happening is not are not ones that the central banks can influence.
Okay, thank you. We have a question in chat, but my suggestion is that we would start with this question tomorrow, maybe. I have written it down. Look, when I scheduled the lectures, I was afraid that putting the two theoretical lectures in a row might have been rather boring. It is not, it was not, and this discussion we had proves it. We are still over 40, and I think it is only fair to thank our lecturer and to thank all those present, and see you tomorrow.
Thank you very much, Dennis.
Thank you.
You're very generous.
Thank you very much.
and you audience are very generous as well to listen to me. Thank you.
Thank you. Thank you.
Thank you very much.